This video is an update to what to do if you have a job transition. This can be both on your own volition, so a voluntary job switch where you're going from one company to another, or you're leaving a company to start your own company, or it's involuntary. You've just been laid off, you've been let go. What are some considerations that you need to make when it comes to managing through that transition and doing so in a successful way? So I'm going to discuss a couple of things that you should be considering and some ideas that might help you make that transition more smoothly. So the first thing is understanding the portability of your employee benefits. This could be your health insurance, your life and disability, HSA accounts, or flex spending accounts, just to name a few. There are a lot of benefits that come with employee benefits. And so you just got to understand that lineup. What is available to you, or what did you already have? What did you already enroll in? And then what is the portability, or how can you move those dollars? And is it possible to move those benefits outside of the current company? I'm going to touch on retirement benefits here in a minute. So I want to leave that for its own conversation. So with health insurance, you've got to be really careful about what you're doing. This is something that I think a lot of people lose sight of. They get some sticker shock. And that's because in the United States, we are allowed with this thing called COBRA, which is basically allowing you to extend your benefits from your employer to while you're not working at that company anymore. And it essentially allows you to keep those benefits. The thing about that is that you have to pay the full fare. So a lot of times for most people, they get that 50% benefit where the employer is paying 50% of the monthly premium. When you go into COBRA, you've got to pay the full monthly premium. So that can make a real difference from a cash flow perspective. So you got to be careful and understand what you should expect from that angle. But you also have to look at what are those benefits and who else is covered under those. So if you've got small children, what does that cost? There's some things to absolutely consider. And then we have to look at what's next. Now we have to think about that. I'm going to talk a little bit about things to consider in the next phase of your career path. But with your health benefits, it's incredibly important to know and have an understanding of what that transition will look like. Another thing that we look at is life and disability insurance. This is a big one because a lot of people are covered under life and disability through their employer. And these are going to be those ancillary benefits that can be hugely popular and very cost effective, where especially with disability. With your life insurance coverage through your employer, is that portable? Can you take that outside of the company and continue that coverage? This might be $300,000, $400,000, $500,000 of coverage, or there's going to be some sort of guardrails for that coverage, but is it portable? A lot of the times I find that people are not covered after they leave their current employer. So again, understanding that could be a potential blind spot. If you need to have that coverage and you want that in place, what does it look like to have it held personally? Is that a possibility? Another thing with disability, especially for a lot of our clients who are very active out there in the wilderness, they're hiking, biking, cycling, they are skiing, super active people, disability is a huge concern. What if you have that accident? And a lot of times with these group benefits that you get through your employer, disability is extremely cost effective and a very small premium. So is that portable? Is that something that you can carry on once you're no longer an employee of that company? Big consideration here. Do you want to make sure that you have that coverage, that there's no gap in coverage for that when you sever service? Another thing that we look at is HSA accounts. Another big benefit for those ancillary benefits is that most companies provide an HSA compatible health plan, meaning it's a high deductible plan. It's usually a lower premium, and you can use an HSA to offset some of those costs. You can also contribute to that HSA. What I find is that in some cases, you're getting a match, kind of like a retirement plan from that company, and they're not going to have a lot of strings attached to those dollars, but understanding the dynamics of what that might look like for moving it out of the company. What is the policies? What are the procedures? Tied to that, and you don't see this as much, but definitely out there, is a flex spending account or flexible spending account, FSA. Oftentimes contributed to by the employer, and it's a use it or lose it thing. So oftentimes either it's through a plan year or a calendar year that you've got to earn, you have a certain amount of dollars, and at the end of that plan year or calendar year, those dollars go away. So it's a use it or lose it type of situation. If you leave a company, those FSA dollars are going to go away. So if you have maybe some procedures, go see the dermatologist, have some sort of medical event, you might try to plan that before you leave the company to ensure that you're taking as much of the benefit that you can from that FSA, because those are your dollars for that year, and it's certainly a benefit that you've got to be aware of. Another thing that is tied to all of this, that's another benefit, but it's such a big thing I wanted to make it its own section, is your retirement plan. Again, similar to how we're structured in the United States with our health insurance, our retirement funding and our retirement savings is often tied to our employer. Makes a lot of sense. You're using your income to save for retirement. And inside the United States, we use the 401k plan predominantly, but there's all types of employer-sponsored plans, whether that's a 457, a 403b, 401ks. There's a whole host of things, profit sharing, and some other pension plans. But I want to talk about that here in a little bit. But specifically related to those 401k or 401k accounts, we've got to understand a few things about it. First, what can you do with it? You can leave it, most likely. You could move it to a current 401k or your new employer. You could roll it to an IRA or something similar. We have to understand some of the bells and whistles that are going on inside there. So it's really good to evaluate what your retirement plan is all set up at. For example, I was working with a client recently, and she had just left her company to start her own company. And we were having a conversation about her 401k. One of the things that she didn't realize is that she knew the total balance of her 401k. And that's how the statement went. But she didn't realize that it was broken down in several different parts. And one of those is that she had some Roth 401k dollars. So unbeknownst to us, until we had a conversation with the provider, we didn't realize that. So when you leave the company, understand what's traditional, meaning pre-tax, what's Roth or after tax. And then also another consideration, is there any vesting that is required based off of the match that the company provides? A lot of companies provide what's called a safe harbor match, which is just a baseline match, usually 4%, sometimes a little bit more. But that's a guarantee. Once it's in your account, it's yours. So there's no vesting schedule to the safe harbor. But sometimes they'll add a profit sharing element, which then comes with, that looks a lot like a match, and it is a match, but it might have some more strings attached. So this could have a vesting schedule, whether that's 3 or 4 or 5 years. You've got to be aware of how that vesting schedule might affect rolling those dollars out, or ultimately the portability of that retirement plan. Again, as I mentioned, what are your options? You can leave it. Oftentimes I don't find that to be a really attractive thing for a lot of clients, because they just want to be done with that old firm. They don't want it. They just want to move on, and they're really excited about taking those dollars out of that fund and not being no more attachment to that company. And if you do, that's great. Where could you move it? You can move it to your current, if you get a new job, you can move it to that current 401k plan. That's a totally feasible situation. The only challenge there is that you're then exposed to just the lineup that they have, the lineup of investments. That can be a little bit of a challenge, but you can continue to build the 401k balance. But you've got to make sure that you understand the different buckets that you have, whether that's Roth or traditional or so on and so forth, and understand what that looks like. Another option that you would have is to roll those dollars into a IRA or Roth IRA. The nice thing about that is that all of a sudden the universe of investments really opens up to you. So you can absolutely do that. And you'd want to work with an advisor. This is something that we do with our clients all the time, is work with their old employer plan and then roll that to an IRA or a Roth IRA, and then help them invest those dollars from that point on. Another thing that you could do, which I highly discourage, is you can cash out. Part of this also is just, you just don't want to do that. We always say, start with the end in mind, with the idea that you want these dollars to really be for retirement. I don't encourage people to cash out their 401ks if they can absolutely help it. One of the things that you need to understand is, I talked a little bit about how your funds are structured. Also think about if you've got a loan into that 401k plan. Sometimes people will take loans out of their 401k and with every intention to pay it back. But if you leave a company, that loan becomes a taxable event. If you just spend the time to pay it back, that's fine. But if you leave the company and you've got an outstanding loan in that 401k, you've got to pay it back, or that becomes taxable. It would become a taxable event if you don't do that properly. So something to absolutely consider as part of all of the pieces that are moving and going every which way. The next thing I look at is preparing for what's next. Now, if you left voluntarily, my sense is that you probably understood that there was going to be a time that you were going to have some transition, there was going to be a gap, whether you had a job already lined up or you were just going to take a break. You probably saw that coming down the pike, and so you can prepare for that a little bit more. This is more aimed at those folks that are maybe involuntarily let go. Laid off, it was a big surprise. It usually happens on Friday afternoons, and now all of a sudden you're trying to figure out what's going on. But regardless, it's always good to plan for the worst and hope for the best. And that's something that I talk to a lot of my clients. So we have to think about, what does that emergency fund look like? This is why we have it. If you've got a gap in your income for 3, 5, 6 months, are you able to cover that? And are you able to withstand that punch and keep going forward? So preparing for what's next is an incredibly important experience, especially if you don't have anything lined up. The job process could take a couple months. I've had a lot of folks that are they've got a great resume, their CV looks great, but yet they get to the round 3, round 4, round 5, and it takes 6, 8, 10 weeks to really get that job offer. So you don't want to do this, and you don't want to come from a place of scarcity and feeling like your back's against the wall. Employers will recognize that, but if you've got your financial house in order, then you can go through a little bit more carefree. You can put out your most authentic self and really show up in the best way. So I look at having that emergency fund as an incredibly important experience, both from just a financial structure, but also from a psychological perspective, helping you transition through that job change. Budgeting also tied to this big aspect of going through where you've got to tighten up the belt, understanding some of those extraneous costs that don't necessarily serve you in the best way, that were fine when you had a really good paying, reliable cash flow from your company that you're working for. But now that you're in that transition, what does that look like? Also, if you get that severance package, how long is that runway? What's the bleed rate, if you will, from just your cash flow needs and things like that, covering the mortgage, childcare, all of the other things that you want to do. Again, part of that emergency fund, but also part of budgeting, is just making sure that you know what you can cut if need be, but also just how to be diligent about it. And as I talked about earlier, health insurance is incredibly important. You've got to manage for what that ultimately looks like. And then it starts to give you that option to say, how did our health plan work before? How does that work going in the future? Something that I experienced here recently with a client is that both of the spouses were employed W-2 employees, and everything was covered under one of the employees, and that was the husband. And that was the whole family. So the family of 4 was under the husband. Well, the husband left his W-2 job to start his own career. And one of the things that they then did is they transitioned everything over to the wife in her health plan. And now that helped manage that household a little bit. But they had to juggle some things for a minute just to make sure that that transition was pretty smooth. So that's another consideration is, again, what's next? What's our health coverage look like? Is this a better deal over here or over here? What are some of the strategies that you want to consider when it comes to that job transition? And then retirement contributions. Again, this is a big one. When you're looking at the new job, what does it look like from the standpoint of the new benefits? Do they have a 401k plan? Do they have a matching program? Do they have a totally different retirement plan where they might have a pension, or they might have some other benefits that you didn't have before? So you need to understand some of the bells and whistles there. But that's also then a big consideration when you start that new job is, how does this work into our longer term financial plan? This is where we have a lot of discussions. I was talking about a lot of clients that have started their own jobs, and they've been contributors to their 401k for years and years. Now that they have their own company, they immediately ask me, what should we continue funding our 401ks or retirement? How do we do that? And oftentimes what I'll say is, maybe right now while you're going through this transition, you don't fund your retirement, because there's a time and a place for everything. And sometimes right now might not necessarily be that moment. And I've noticed that when I give that guidance where it's appropriate, clients will often say, wow, that made me feel so much better because I didn't know, I felt really guilty for not contributing to my 401k or my retirement right away. And then 6, 8, 10, 12 months go down the road. Now all of a sudden their cash flow is a little bit more smooth. There's a little bit more reliable income sources, and they can now make those contributions and feel a little bit more confident about that. Another aspect is prior to leaving the firm, prior to leaving your company, if you're going to be quitting, what are some financial considerations? Again, I talked about a little bit of understanding what are the benefits that you're leaving behind. So this could be, for in some cases, what are the retirement benefits, or what are some of those compensation packages that you're leaving behind? This could be your RSUs, ISOs, EPs, all of these factors that kind of play into some of the other facets of your overall financial structure, and really understanding how those things work and how they're compatible to that transition. So as an example, clients a lot of times will have ISOs, or incentive stock options, or RSUs, or restricted stock units. And many of those you might get 5,000 RSUs, but there's going to be a vesting schedule. So let's just say it's over a 4-year period. If you leave at year 3, you leave on the table many of those options or those units. And so you've got to be aware of what you're giving up when you leave. And that's also a big factor of what we have to think about with the benefits that you have. If, let's just say, you're 8-10 weeks off from a vesting period, does it make sense to just stick around for that 8 or 10 weeks? I've seen that where a client was about to quit and everything vested in 6 months. And they looked at me and they're like, gosh, that's going to be a tough 6 months. But guess what they did? They stuck it out, they did it, and they got through it, and they vested all of those dollars. And it was a huge benefit to them. And it was a very significant amount of money. And so you've got to look at that. Understand also the costs. So this is another factor that's attached to some of those benefits, but a little bit different. So when I think about costs, I'm thinking about some of the things that your employer covered that maybe you're not accounting for. And I had talked about COBRA, where you're using your benefits, your health benefits, and you get that 50% contribution, or in a lot of cases more than that, for your healthcare premiums on a monthly basis. And then when you go into COBRA, you're paying that whole fare. So you might think that you're only paying $300 a month, but really, let's just say the total premium is $900 a month. So that's going to have to come out of pocket when you are now transitioning. And if you want to keep that or not have a gap in coverage, you've got to make sure that you're aware of that and you're budgeting for that additional cost that's going to be out of pocket. Another thing that we look at is those health benefits, the life insurance and the disability. If you have a portable life insurance policy, you're going to have to start paying those premiums out of pocket, whereas before it was probably paid out of your paycheck. Same thing with disability. So just making sure that you don't have any lapses in those coverages if you so desire. That's a big thing. So those are some factors. There are also some other things that kind of you want to consider as well. Is you might have to give back computers. You might have to give back some technology. So are you going to be left in a little bit of a tough spot if some of the company-owned equipment is at your house and you've been using it as maybe some personal stuff? So those are some interesting dynamics that I've seen in the past. Also, plan for income gaps. So understanding, let's just say you're quitting a job and you know that you're starting a new job, but there's maybe a 4 to 6 week period where you're having that transition. Understanding what's going to happen during that period of time, because even if you do start there was a month gap, and then you may not get another paycheck for another 2 weeks. So there might be 6 weeks that you actually don't have income. I've seen this with a lot of clients. Is they're like, yeah, I'm quitting on Friday and I'm starting my job on Monday, but then they don't get paid. They might have missed an income pay period. And all of a sudden they're like, wait, that was shocking. I didn't realize I was going to miss a pay period. And that really hurt us, and it was a big surprise. So going about this in an unsurprising way, where you're able to uncover all the issues that might be there. And then finally, if you're looking at navigating severance packages. So if you are leaving a company involuntarily, you've been laid off, this is something that I think is really important, is understanding all the details that go into a severance package. So a lot of times it's some of the nuts and bolts of it is that you get paid out a period of time, maybe it's 4, 6, 12 months of your income. And the idea there is that they're laying you off, but it's giving you some sort of a runway to work with. So you've got to understand what that package looks like. What are some of the baseline stuff, so the income that you might receive, But also, will they pay for health coverage for that period of time while you're maybe 6-12 months? What are some of the benefits that they might provide? And you could actually negotiate some of this stuff. So you can actually talk to your HR professionals within the company and see if there is some wiggle room. If you need to have something extended for a little bit longer, something's happening, you can talk to them and see if there's some areas where there's maybe a little bit of flexibility. You also want to look at your tax implications. So if you do receive some sort of a severance, that's going to be taxable. So you've got to look at when is that tax. So let's just say you get laid off at the end of a year, and so you have almost a whole year of income, and then you slam 6 months of income into 1 month. I've seen this, and all of a sudden it feels like you've had 1.5 years of income in 1 year, and all of a sudden your tax bill goes up. And that can be a little bit of a shocking experience. So people have to understand, what are the tax implications of this severance package and being laid off? Are there other things? I've also seen in some instances, rarely, but sometimes, where a client has an accelerated vesting schedule. But that can also create some phantom income where, especially with RSUs, you can actually see this happen where they go through and those dollars vest when they weren't expecting it. And now they've got this income that they've earned, that they've incurred, but they haven't earned and they haven't seen it in their account. But that'll absolutely hit their 1040s at the end of the year. Another thing that we've already talked a lot about is this idea of benefit continuation. How long do the benefits continue for? What are the portability rules? What are some of the compatibility rules that you need to think about? And then the last thing that you really want to consider is reviewing with an attorney. I think it's really smart before you sign anything, maybe just have an attorney, a trusted attorney, review those documents, and a financial advisor, not necessarily to your legal requirements, but just having an advisor like myself go over just the financial package that you're looking at. So what's the total package? What are the benefits? What are the pros and cons of that? And understanding ultimately, what does that do for your family? These are some of the considerations that I would talk with my clients about through a job transition. Again, this could be voluntary, where you're leaving and you're starting a new career, or you're starting your own business, or involuntary, you've been laid off and you're not sure what to do. These can be incredibly challenging times, and if you have your financial house in order, they can make that transition much smoother. And this is something that we consult with our clients a lot, and we help them through those messy challenges and make them much smoother.